3.0. So in this video, I'm going to talk about the current cryptocurrency market and why it's selling off and what it's contributing to the sell-off and what the factors driving it. Because as you can see here, the market had an amazing peak towards the end of last year. So this would be about November last year. So let me zoom in more here. So we can see that the peak of the market was around November, mid-November, where the market cap was at $3 trillion. What's that? 60 or 70% reduction from the all-time high. And as you can see here, the market is down about 54% year on year. So what's driving this? What are the factors driving this big sell-off in cryptocurrency market cap and the sell-off across the broad markets in general? Because it's not just cryptocurrencies that are down. You've got stocks are down, you've got real estate's down, the whole asset markets are selling off. So what's driving this and what's the factors that's contributing to this? Because it'll give us some indication of what might be the catalyst that will initiate the next bull market. So let's talk about this in more detail. So one of the main factors driving the market, and if not one of, I would say the main factor driving the market right now, is the rate of inflation. So what is inflation? So inflation is basically the cost of general goods and services, so the things we consume on a day-to-day basis, and the things we buy. It's just how much are they increasing year on year? So your groceries, your fuel, stuff like that. If you've been to the supermarket recently and compared your shopping basket to a year or 2 years ago, you'll notice that things are a lot more expensive than they used to be, probably to the tune of around 10-20%, depending on where you live, more expensive. If you look at fuel, to fill up your car is a lot more expensive than it used to be a year or two ago. So the price of things are going up, and this is a result of the government pumping significant sums of money into the economy as a result of the pandemic when that took place. So to stimulate the economy and to stop the economy going into a recession and effectively just falling over after the lockdowns, the governments around the world pumped a lot of money into the market called quantitative easing, and this increased the money supply. And when money supply increases, this leads to significant cost pressures, and which is now being felt with regard to inflation, because it's you don't increase the money supply today. You don't increase the money supply today, and the cost pressures just happen tomorrow. They tend to be a lag from when the money supply is increased. So if we then look at the chart here, it gives you some indication of where inflation has been. So for pretty much a lot of the year, so let's go first to the 1 year chart. So what we can see in the 1 year chart here is inflation in the United States has been on an astronomical rise. In October 2021, we're looking at 6.2%, and the peak reading, which is around June 2022, was 9.1%. That means the general price of things has got nearly 10% more expensive year on year in the United States. And these are government figures, and they tend to be quite massaged. So it's not, it's the real figures probably double the government figures, but you get the gist that things are more expensive. If we look at a more longer term trend to see where inflation has been, you can see that we're at the highest we've ever been for close to 10 years now. At inflation at the kind of 8-9% we're experiencing today is significantly higher than the 2% it's been averaging. That's about 4 or 5 times increase on what we typically expect the cost of things to increase by year on year. So this has created significant pressures for governments around the world, and central banks have to act. And in order to bring inflation under control, one of the biggest tools central banks have within their arsenal is the interest rates. So what you're finding now around the world is whether that's the Federal Reserve, so the American Central Bank, the Bank of England, which is the UK Central Bank, or the ECB, the European Central Bank, they're all increasing their interest rates. So why are they doing this? Why are they increasing interest rates? Because as you increase interest rates, that means borrowing costs becomes more expensive. So mortgages become more expensive, credit card and other debts become more expensive, and that means people tend to borrow less. And if you borrow less money, that means you have less money to spend. And if you have less money to spend, then it reduces the cost pressure on goods and services in the economy. As well as that, if borrowing cost increases, then companies' costs increase. It becomes more expensive to finance expansion and finance investing activities. The companies scale back on these activities. They scale back on staffing numbers. They scale back on things like wage increases. And these things tend to, once disposable incomes and spending power reduces, then as people spend less, that's less cost pressure. So that's the theory. The theory is if you make the cost of money more expensive, people will spend less of it, and thus there'll be less pressures increasing costs. So that's what the government's trying to do. It's trying to get inflation under control by increasing interest rates to make borrowing more expensive, to reduce people's disposable incomes. And the theory is that should lead to a reduction in spending pressure, and that should, in theory, start to bring down the rate of inflation. We've not really seen that play out just yet. Encouragingly, we've seen inflation dip slightly in the last couple of months when it peaked in June at 9.1%, and now the latest print for August was 8.3%, so that's positive. but 8% inflation is still very high, and the Federal Reserve is pretty much committed to increasing the interest rate until inflation starts to show meaningful reductions. Don't know exactly what that means, but I would assume until we're at probably 5% region and below, the Federal Reserve will stay their course of increasing interest rates. So whilst that's happening, there's going to be lots of sell pressure in the market. The market's going to be quite bearish across the patch. So another thing to look at as well, where that's a good indicator about the state of the markets, is the United States Dollar Index. It's also called the DXY. As this is going up, that means the dollar's getting more, getting stronger. So as we saw here, November 2021, this is the peak of the cryptocurrency market, around 15th of November, mid-November. The DXY was around 95, and now it's at 113. A significant increase in the strength of the dollar. And as the dollar keeps on getting stronger, asset prices tends to get weaker. And this is because a stronger dollar means lots of investors are running to safe havens. They're putting their money in to what they believe is the safest economy whilst things are uncertain, which is the United States dollar. So as people start buying up the United States dollar, they're parking their money to a safe haven economy. That means they're taking their money out of risky assets like stocks, like crypto, like real estate. So there's an inverse correlation between the DXY and markets. As this keeps going up, markets will sell off. It's only when the DXY starts to, decline and reduce, then we should start to see a rebound in the markets. As we see here, if you correlate reductions in the DXY, you should tend to find that there's a reduction in an increase in asset prices. So if we look at the DXY then to just illustrate the point. March 2020 was the peak of the lockdowns when the peak of the pandemic. And as we saw here, from March 2020 to till May 2021, the DXY was just falling, and at that price we had one of the biggest bull markets in stocks, in crypto, and real estate, and all assets. And as the DXY started climbing, obviously that corresponded with the sell-off in assets. So until the DXY turns around, then we should expect the sell-off in assets to continue. But again, it's one of those catalysts we need to look forward to, and we need to look at that when the DXY does start to reverse, this could signal that a bull market is back on the horizon. So I mentioned earlier that it's not just cryptocurrency that's selling off, also the stock market. This is the US 30, also known as the Dow Jones, the Dow Jones Industrial Average. And if you look at the Dow Jones, that's been absolutely crushed. Compare the peak here of around January 2022, when it was at 37,000 points, to just below 30,000 points today. You're talking about nearly 30% reduction in the Dow Jones Industrial Average. That's a significant dip for the stock market, significant sell-off. And if you look at some of the big names here and how they've performed year on year, Intel down 50% year on year, Salesforce again 50% year on year, Nike 36%. Just look across the patch, significant reductions in blue chip companies. These aren't penny stocks or incredibly risky stocks here. These are companies with solid fundamentals, solid cash flows, solid management teams, and solid balance sheets that are falling 50% per year. Incredible. So it's not just the crypto market that's selling off. Across the whole horizon of assets, we are seeing a significant sell-off driven by the inflation risk and economic uncertainties that currently face many of the major economies. So, as mentioned earlier, the biggest tool that the Federal Reserve are using to get the inflation rate under control is the rate of interest. And if you look at the interest rate, it's gone up significantly from 0.25%, where it's been for a long time, to now it's now at 3.25% after the Fed's latest increase on the 21st of September. And many expect this to increase to maybe 4.5%, 5%. So as the Fed continues to increase interest rates, then the market expects there to be continued sell-off because cost of borrowing is going up, and these tend to be associated with adverse economic fundamentals. So until the Federal Reserve signals it's got inflation under control, interest rates aren't going up anymore, I think the market is going to have some sell pressure. But once we kind of clear those headwinds, inflation starts to come back to meaningful levels that the Fed's targeting, your 5% plus, 5% and below, and the Fed believes they can take their foot off the gas on the interest rates, then we can, once that happens, we can start to look forward to a bull market. But until we meet those criteria, I think it's safe to say the market is still going to be relatively uncertain. Another thing to look at is quantitative tightening when the Fed starts to sell off its balance sheet. So I don't think the market's strong enough to absorb the Fed selling assets right now. But I think if that does start to happen, that could be also another bearish signal. But we're not really there yet, and I don't know if the market can sustain that into a meaningful way. The Fed is best to deleverage in a bull market because that's when there's appetite from investors to buy off assets, not in a bear market. So I don't know if the Fed will start along that path just yet, but that's something to watch. Again, if we look at the 10-year trends in interest rates in the United States, we talk about the United States here because the economy pretty much is the bellwether for the rest of the world, because a lot of economies are dependent on what the United States is doing and what the Fed is doing. So the United States market is a very important market to watch because it has a significant bearing on global markets and global assets. So if we look at current rates of interest, best to go back a bit further, so maybe 25 years, we are effectively on a territory we're approaching interest rates not yet seen um, until before the financial crisis of 2007, 2008. That's incredible. If you look at the chart here, we're currently at 3.25%. The rates before the financial crash was around 5%. Um, we are about to head into uncharted territory. We haven't been at rates this high for about, what's that, maybe 12, 15 years. We haven't had interest rates this high. So these economic uncertainties and these economic factors are what's really weighing heavy on the market. And until we start to move past inflation risk, interest rates starts to the Fed starts to signal that they're not going to increase interest rates any further. When we start seeing the DXY index start to fall, I think until we get those factors start taking place, we could have some more bearish signs in the market. But at least we know what the catalysts are, what we need to look out for to signal that there could be a reversal of trend. So I hope you like that content. I hope you found that very informative, very interesting. And this is Alpha here. Watch these key signals: inflation, DXY, interest rates, because these are the catalysts that will signal when the next bull market it's up and coming. So again, thank you very much for tuning in. Hope you enjoy that content. Please like, subscribe, and share. Have a good day, everyone.